Hello! So today's lesson is an oversimplified version of what you probably dealt with before concerning bonds. So let's start with an introduction to bonds. What are bonds? A bond is essentially a loan. In this case, you are the lender, and the borrower is the country or corporation that issues the bonds. When you buy a bond, you lend the issuer your money, and they pay you back with interest. Now, this is an important stop before moving to some key bond terms. Bonds versus stocks. A stock indicates owning a share in a corporation representing a piece of the firm's assets or earnings. Any person willing to contribution to the capital can have a share if it is available to the general public. However, bonds are loans that are secured by a specific physical asset. It highlights the amount of debt taken with a promise to pay the principal amount in the future and periodically offers them the yields at a pre-decided percentage. Let's quickly summarize some key terms that we use when talking about bonds. We have principal, maturity, yield, coupon. And now to the different types of bonds. Though there are different types of bonds, fundamentally all bonds follow the same or similar structure. These are supranational bonds, corporate bonds, government bonds, and municipal bonds. First, we have supranational bonds. A supranational bond is a long-term form of debt that transcends the boundaries of a single country. Typically, they are formed by two or more countries. This helps to promote growth within the economic areas. These are very similar to government bonds and tend to have a high credit rating. Next is the government and corporate bonds. Government bonds are called gilts and allow governments to borrow money to finance public spending. Government bonds are a type of sovereign debt. Government bonds typically have maturities of medium or long time frames, anywhere from a couple of years up to several decades. Corporate bonds allow companies to grow their business or undertake new projects by raising more funds than a bank might be willing to loan them. And lastly, we have the municipal bonds. The municipal bonds are a type of sub-sovereign bond. In the United States, the bonds issued by the federal government are treasury notes and bonds, as mentioned above. Below the federal level, smaller branches of government also issue debt in order to fund their capital spending programs. Debt securities issued by a local government entity or agency, such as states, cities, counties, and even schools and publicly owned airports, are called municipal bonds or muni bonds. And finally, the last part of our lesson for today, Sukuk. Since there is no equivalent word for it in English, the Arabic word that you are familiar with is pronounced the same in English. Now, since Islamic law prohibits what's known as riba, or what we understand as interest in the West, therefore, traditional Western debt instruments cannot be used as a viable investment vehicles or ways to raise capital for a business. To circumvent this, Sukuk were created in order to link the returns and cash flows of debt financing to a specific asset being purchased. effectively distributing the benefits of that asset. This allows investors to work around the prohibition outlined under Sharia and still receive the benefits of debt financing. Now, Sukuk and conventional bonds do share similar characteristics, but also have important key differences. Now, for the similarities, both provide investors with payment streams. Bonds and Sukuk are issued to investors and may be used to raise capital for a firm. Both are considered to be safer investments than equities. Sukuk investors receive profits generated by the underlying asset on a periodic basis, while bond investors receive periodic interest payments. Now, move into the key differences. Sukuk involves asset ownership, while bonds are debt obligations. If the asset back in the Sukuk appreciates, then the Sukuk can appreciate, whereas bond yield is strictly due to its interest rate. Assets that back Sukuk are halal, whereas bonds are often riba and may finance non-Sharia compliant businesses or fuel speculation. Sukuk valuation is based on the value of the assets backing them, while a bond's price is largely determined by its credit rating. And that is it for today's lesson. Thank you for watching.